Welcome back, everyone, to this week's analysis. The Federal Reserve just put off what was probably one of the greatest rug pulls in history. On Tuesday, we had Jerome Powell coming out and speaking, and it sounded more like a sitcom. And then the very next day, his friends brought the pain. So let's recap what happened. This all started really back on February 1st, a week before on Wednesday, whenever the Fed did a 25 base point rate hike instead of a 50 base point rate hike. And Jerome Powell came out very dovish. He said the word disinflation probably around 10 times, and the markets were eating this up. This ended up sending SPY almost to $420 within a few days. And then on Tuesday, he had an interview over in Washington, D.C. with Mr. Rubenstein, and it's honestly felt like more of a stand-up show than anything. It sounded like there was actually some sort of laugh track. I'm not really sure what was going on there, but it was a very relaxed interview. He didn't really say much, but then there was one point in the interview where things really turned around. And the comment that he had made was that we could raise rates higher than we previously anticipated. Now, the Fed has been projected to raise rates up to 5.0 to 5.25% sometime by the end of this year, based on the summary of economic projections that came out in December. And whenever Powell said this immediately caused the markets to sell off, and we saw the odds of 5.25 to 5.5% interest rates from the Fed jump from about 10% to 30% overnight. And then his friends from the Federal Reserve followed him up the very next day, echoing the same sentiment in that they could raise rates higher than they previously expected. So we might be going to 5.25% to 5.5% interest rates instead of the previously projected 5.0 to 5.25%. So another quarter basis point rate hike, or another 3 quarter basis point rate hikes to go from where we're at right now. And the market started to absolutely panic over this. Another quarter basis point rate hike, and the market shit the bed. SPY ended up going from about $418 at the top of the week all the way down to $404 sometime on Thursday. So it was an absolute bloody mess on Wednesday and Thursday for the markets. And then it ended up recovering a little bit on Friday. So it was a very chaotic week for the stock market, to say the least. And the reason why the market sold off so hard was because of the rising interest rates and what we're seeing in the bond market. So the bond market is where interest rates are set. Whenever people are buying bonds, this means that the rates are going to go down because there's more demand, there's more people that need to be paid out. So the yield for the bond ends up going down whenever there's more buyers. But whenever there's more sellers for the bond, the exact opposite happens. Whenever more people are selling bonds, the rates start to go up because there's less people to pay out with that bond. So right now, we're seeing a lot of people selling out of bonds, and the reason for this is because of the bond market volatility. Whenever we're seeing interest rates going up 1%, down 1% the next day, and seeing gap ups in the chart overnight, then people in the bond market that are used to stability are panicking out of their positions, which ends up in the rates going up. And whenever the rates go up, stocks tend to come down because this means that there is going to be lower growth in the future because it costs more money in order to grow a business by using debt, which is what tech companies and growth companies have been doing over the last 10 years whenever interest rates were so low, since the Fed kept interest rates at 0%. So now that the interest rates are rising, these growth companies can't grow using debt, and if they don't have a high cash balance in order to grow the company, then they are SOL. So this bond market volatility is causing a whole lot of fear in the market, and we've been seeing a huge disconnect between the markets and bond volatility. Usually the QQQ and the bond market have an inverse relationship with one another, but in early February, we actually saw both interest rates and QQQ going up at the exact same time. So this is creating a lot of risk to the downside if interest rates continue to go up like we're seeing. And the Fed might even have to raise rates even more considering inflation expectations. If we're looking at the Michigan Economic Report, we saw the one-year inflation expectation go from 3.9% last month to 4.2% this month. So this means that the consumer is expecting inflation to pop its head back up and go higher. And inflation has a psychological effect where if people think that prices are going to rise in the future, then they're going to buy the goods at a cheaper price right now, which ultimately ends up in more inflation right now because there's more demand to buy the same amount of goods, which means that prices will go up. And for some reason, the consumer actually thinks that the economy is doing really well, according to this Michigan economic report. I'm not sure who they're interviewing for this, but the consumer apparently thinks that the economy is doing just as well now as it was back in January of 2022, before the Fed started to raise interest rates and before we saw 8-9% inflation. So to me, this smells like stagflation, and what stagflation is when we have a period of slow growth, but growth nonetheless, which is what the consumer is expecting, but we also expect to see higher inflation. So if you have a combination of slow growth plus inflation, this is what's known as stagflation. This means that people's buying power is going to be eroded because of the higher prices that people are having to pay for goods, foods, transportation, and housing, which means that they don't have as much money to spend elsewhere in the economy. So this means that corporate earnings are going to be coming down if we see this stagflation. And this is the way that inflation always goes. It starts with inflation, it leads to stagflation, and then it always ends in a recession. That is a natural progression of inflation to getting rid of inflation. The only way in order to get prices down is to either destroy demand or increase our supply. And right now, our supply chains are in a very tough time. So unless we're able to magically fix our supply chains, we need to destroy demand and we need to experience a recession. And speaking of stagflation hurting corporate earnings, Lyft had a horrible earnings report this quarter. They posted a negative 161 actual earnings per share versus a negative 48-cent earnings per share, what was expected from Wall Street. And they gave a revenue guidance of only $1 billion. And considering their cash balance, this puts them in a really sticky spot because this business burned $237 million in operating activities, and they only have $391 million left. This means that they only have about 1.5 years until the company runs out of cash. Now, they can always sell off their debts in order to come up with more cash, or they can sell off their stock, but this puts them in a really sticky spot, especially considering how low their share price is trading. Lyft stock ended up falling by 30% after the earnings report, and I was able to take advantage of this opportunity by buying a put debit spread. And if y'all want to see the trades that I'm making every day, check out my premium Discord. It's linked down in the pinned comment. But the next earnings report that I want to talk about is Uber. Uber posted a 29-cent earnings per share versus a negative 22-cent expected earnings per share. So they ended up beating earnings by a good bit. And they're expected to do 20 to 24% more rides in the next quarter than they did for this quarter. So the CEO is very optimistic about the company continuing to grow, and he says that there are no signs of consumer weakness as of right now. And unlike Lyft, they don't have a dipshit for a CFO. They have $7.8 billion in cash left, and they're only burning around $244 million a year, which means that this company can last for about 30 years on the cash balance that they have on hand. So they're in a lot better of a position than we're seeing for Lyft. And this ended up in their stock rallying by a good, few percent. And finally, the last earnings for this week was Disney, who reported 99-cent earnings per share versus 69-cent earnings per share expected. And this also came off with a layoff announcement of 7,000 employees. And, whenever there are layoffs, the stock ends up usually rallying by about 5%, which is exactly what happened. But then Disney ended up giving all of its gains back because of the huge market sell-off that we saw on Wednesday and Thursday. And of course, we had Bob Iger coming out and being Bob Iger. He's a very jaded individual, very cutthroat, but investors love this. They love that he laid off 7,000 employees, and he probably still gets to keep all of his executive pay. But hey, that's business for you. So that's the recap of what happened this week, and for the upcoming week, we have some pretty big news coming out. So we have CPI coming out on Tuesday at 8:30, where we're expected to see 0.4% month-over-month inflation, which is the same reading that we got for last month. But I personally think that it could be a little bit higher. And the reason why I think it could be higher is because of energy prices going up. Energy prices ticked up just a little bit from December to January, and this rise in energy prices is likely to lead to a rise in good prices. Energy is the input to where people need energy to run their business. They need energy to transport goods. So if energy prices are rising, then goods prices are likely to rise with them. So that's what I'm thinking for CPI. I think we could see 0.5% month-over-month inflation instead of the 0.4% is what is expected. And I think if we do get that reading, then we're probably going to sell off a good 2% or so from where we're trading right now, down to about $400. But obviously, this is only my best guess, but I'm probably going to be taking a 400 put debit spread, assuming that we will drop that 2%. And then next, we have retail sales coming in on Wednesday at 8:30 in the morning. We're expected to see 0.7% higher retail sales for the month of January after being down by 1.1% in December, which is usually one of the best months because of the holiday season. But maybe we're going to see a rebound in retail sales after this holiday slump. Considering the loosening financial conditions with SPY going up by 13% and the drop in interest rates, I really wouldn't be surprised if we do see a good reading for retail sales in January. And finally, we have a bunch of Fed members coming out to speak this week. We have Fed Bowman coming out on Monday at 8 a.m. Then we have Fed Logan coming out on Tuesday at 11 a.m. Williams is coming out on Tuesday at 2:05. Bullard Thursday at 1:30. We have Cook coming Thursday at 4 p.m. And then we have Fed Mester coming Thursday at 6 p.m. So a bunch of Fed speeches this week, and if it's anything like last week where they're talking about higher interest rates, then QQQ is likely to fall. But if you want to hedge your position, then the Dow Jones, Industrials, and staple stocks would probably be your best bet. So those are the macro events that we have this week. And the earnings for this week are going to be Coca-Cola, Shopify, and DoorDash. So for Coca-Cola, I expect them to do pretty well in their earnings just because low-price goods have better leverage in order to increase their prices. You can look at the McChicken, which was $1 on the dollar menu, and now RIP dollar menu. The McChicken is $2.69. So these low-price goods have a lot of leverage in order to increase these low prices because people can still afford them. So with Coca-Cola selling their bottles for $2 a piece, now they can raise the prices to maybe $3, $4, and improve their margins. Their expected earnings per share is 45 cents. Their previous earnings per share was 69 cents last quarter and 65 cents a year ago. And over the last 8 quarters, they've done an average of 60-cent earnings per share. So I think that Coca-Cola is going to be doing better for this earnings season in terms of their earnings per share. When it comes to their revenue, they're expected to do $9.92 billion in revenue versus $11.1 billion last quarter and $9.5 billion a year ago. And historically, they've done $10 billion in revenue over the last 8 quarters. So for me, I'm thinking that Coca-Cola is likely to be on both revenue and earnings, but this could already be priced into the stock. We'll talk about the price analysis later on. Next up, we have Shopify, and my concern with Shopify is retail sales slowing down in December, which is usually one of the best months for retail sales. So they're likely to see lower sales volume this year than they did for the year before. And the revenue estimates are $2.21 billion versus $1.38 billion a year ago and $1.37 billion just 1 quarter ago. So Wall Street is expecting a huge jump in their revenue, especially considering their average revenue at $1.18 billion a quarter for the last 2 years. So I don't think they're going to be able to meet the expectations whenever it comes to revenue, but for earnings, they're expected to do negative 1 cent earnings per share versus negative 14 cents a quarter ago and positive 6 cents a year ago. And their average earnings per share has been positive 5 cents for the last 2 years. So I think that they could end up beating their earnings per share, but revenue I think is going to be a huge miss. And finally, the last earnings that I'm going to be watching this week is going to be DoorDash. And after seeing both Lyft and Uber, I think this could go either way, but it's really going to depend on their cash flow statement. We saw that Uber had a really good cash flow statement, but Lyft had a really poor cash flow statement, and the stocks reacted accordingly. Now, if we look at DoorDash, they have $2.3 billion in cash, and they are free cash flow positive. But the reason that they're cash flow positive is because of employee stock compensation. And considering that their stock is crashing and they spent about 16% of their cash balance on share buybacks, do we think this is sustainable? I think that if and when they stop doing this share buyback program and this employee stock compensation slows down, their earnings per share is going to plummet on a non-GAAP basis. But the earnings per share is expected to come in at negative 70 cents versus negative 77 cents a quarter ago and negative 45 cents a year ago. And historically, they've done negative 75 cents a quarter for the last 2 years. In terms of revenue, they're expected to do $1.76 billion in revenue this quarter versus $1.7 billion a quarter ago and $1.3 billion a year ago. And their historical average has been $1.33 billion. So they're expected to increase their revenue by about 40%, whereas their earnings per share is supposed to stay around the same. So this means that their margins are expected to be decreasing, and I think that there's a good possibility that they could end up meeting or beating their earnings per share considering their stock buybacks and considering their employee stock compensation. But how are we going to trade this? Well, we should look at our price analysis. So for DoorDash, the expected range for this week, highlighted in blue right here, is between $50 and $64. So they're expected to go either up or down by $8 in either direction, which is a move of around 13%. So that is a lot of implied volatility, which means if you're going to buy call options or if you're going to buy put options, you're going to be paying a lot in order to open those. And if we're looking at supports and resistance here, we have a 56.47 support, we have 52.50, and then outside of our risk range below $50, the lowest price level that I have up is $47.50. So those are the prices that we're above right now. And then for resistance, the prices were below. We have $61.12, $65.50, which is above the expected range. And then finally, we have $73.57 if they end up blowing earnings out of the park. My estimate is that they're probably going to either meet or beat their earnings per share, which will probably end up in their stock trading flat. And my best guess is that they're going to trade between $53 and $61. But if they end up missing on their earnings per share and their revenue, I think this stock could easily go below the 52.50 mark, which we could probably open a put debit spread, assuming that it would be below 52. But if we're expecting it to trade flat, I would do an iron condor between 53 and 61. Next up, we have Shopify, which is expected to be in a range of $43 to $54. And for supports, we have 46.40, we have 43.91, and 40.5. And above the price levels that we're trading right now, for the resistance, we have 49.15, 50.6, 54, and 58.5. If we see a miss on their earnings per share, which is what I'm expecting considering the slowdown in spending that we saw for December, this is probably going to be heading below $45 or below this 46.40 mark. And considering the small range of only 11% compared to previous moves, I think this could warrant us buying a put option instead of a put debit spread. So if you're going to buy a put option, look for a break even of around $45, and I think this could be a decent opportunity. But if they end up beating on their earnings per share, I think this could end up holding above this 46.40 mark. So I would be probably opening a put credit spread, assuming that it would be above 47. And finally, the last stock for earnings this week is going to be Coca-Cola, which is expected to be in a very tight range of only $57.50 to $61.50, which is only up or down $2 in either direction for a huge move of only 3%. We've got supports at 59.20, 58, 57.25, and 56.11 if it's really bad. And then for resistance, we have $60, 61.24, 62.11, and 63.25 if they have a really good earnings report. I do think that if they surprisingly miss on their earnings per share and their revenue, then Coca-Cola could easily go below this $58 mark. And considering that the expected move is only 3%, this would be a good opportunity to buy put options with a break-even at 58. But if you expect Coca-Cola to do well on their earnings, which is what I'm expecting, I think this could easily stay above around $59. I think this could easily stay above probably $59. So I would be opening a put credit spread, assuming over 59, if you think that they're going to beat their earnings per share and beat their revenue. And finally, to finish the video, let's do a little SPY analysis ahead of the huge CPI report. We've got some supports at 406.60, 401.44, and then 395.78. For resistance, we have 411.02, 417.23, and $420. The expected move for this week is pretty wide, between $397.50 and $418.50, which is a move around $10.50 in either direction, which is about 2.5%. If we have a higher CPI than what's expected, if we do get that 0.5% reading versus the 0.4% reading that's expected, then I do think we could end up going below this $401.44 mark. So I would be buying a 401 put debit spread. But if we get a better CPI than what is expected, I think this would easily stay above around $403. So I'd be opening a put credit spread assuming over 403 if you do think that CPI could come in lower. So that's the price analysis for this week. Hopefully this video was helpful. If it was, show some love, leave a like. Thanks for making it all the way to the end of this video. Thank you to all my patrons and my channel members. Remember to stay positive, stay green. I'll catch you in the next one. Bye, guys.